Let's Get Down to Business is presented by Bravo, the marketing arm of Ash Brokerage Corporation, a practice enhancement company. All this week, it's tax advantage income with life insurance. And on today's show, life insurance and taxes. And with me today is Ken Davis, CLU, CHFC, CFP, and CPA. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Backroom Technician. Let's get down to business. Well, welcome to the show, Ken.
Hey, Steve. Good to see you again.
Always good to have you on our show. We're talking about your wheelhouse, taxes. I can't say I really am in love with taxes, Ken. I have to be honest with you. But we're going to talk about the tax advantage, our tribute. All this September, we're doing things on life insurance as an indemnification, life insurance second to die for inheritance. But today and all this week, we're going to be talking about the tax advantages. And there are. But before we get into the tax advantages, Ken, I want to talk about some of the big blocks that consumers have to pay. It's a psychological block in my mind because I always have to think about, well, I have adjusted gross income. I have modified adjusted gross income. I have alternative minimum tax. I have capital gain tax. I have ordinary income tax. I have the new Medicare tax. I have the new Obamacare tax. I can't keep it straight anymore. I was hoping that when we went through all this new change, that we would actually have a simpler system, and now it's more convoluted than ever.
Indeed it is, and maybe I'm a little cynical, but basically I think the government likes us to be in the dark because when they came out and said we're going to raise taxes, everybody raises a hullabaloo and they're not able to raise the taxes. So they found ways around it, and they chip away at us with with deductions, exemptions, credits. Modified adjusted gross income has become a popular one. There's now 3 different MAGIs that I'm aware of that affect taxation. We used to have one capital gains tax rate. Now we have several, depending upon what kind of capital asset it is. So it just gets more and more complex. And the reality is, CPAs and insurance guys should be working together. The insurance people, we're going to be talking about this today, know how to use their products to create tax-free or partially tax-free income, as well as deferral. And the agents really should have the CPAs involved so they really see what the impact is tax-wise.
Well, we have a form called the 1040 overlay that we will absolutely give you if you say, Steve, I love that idea. It really helps galvanize our thinking in regards to taxes and how we can really help our clients modify and mitigate some of this. Now, Ken, when we're talking about, I'm thinking about the AMT. Now we finally changed it. I remember we were griping for years on our previous shows until it changed. They never booked it and marked it to inflation. So now we're talking about something it's changed a little bit. Did we get really any relief off of that?
Yeah, we did. And basically when alternative minimum tax was put into place, the intent was to go after rich people that are utilizing the tax code and its deductions to an extreme, or what they thought was an extreme. And so they said, okay, we will let you have X amount of dollars of tax benefits, and then after that, then the AMT kicks in. And the whole idea is, well, why do these really wealthy people pay no taxes? That was why it was put in place. Unfortunately, the exemptions, the portion that you exclude first, weren't inflation adjusted. And so, gosh, over 25 years, even at 3% inflation, you have to double the deduction in order for that to work.
I mean, we had middle class people paying AMT. It was never really targeted for middle class taxpayers.
Well, that's right. And so Congress each year played the game at the very tail end of the year, and in fact it went into the next year, 1 year, of adjusting it for 1 or 2 years at a time. And I think a big reason for that is they did not want to admit in their budgets that this revenue, this phony revenue they're going to get from the tax when this went away wasn't going to be there.
Well, when we think about ordinary income tax, capital gains, AMT, I'm just naming a few, and of course how that even impacts Social Security on retirement, which we're going to talk about later on in the week. I'm trying to think about tax advantage of life insurance. Those advantages are so huge because they can mitigate some of the things that we're talking about, especially for retirement. Most people that use cash value life insurance, of course, is using it because it's a long-term supplemental retirement plan. So we're not looking for short 10 years and I'm out. We're really trying to commit to some disciplined deposits. And I like this idea of using cash value life insurance because if it's done correctly, and by the way, Ken, you can get on your high horse if you want. If it's done correctly, it's fantastic. If it's done wrong,
It's trouble.
it's trouble, real trouble.
And I think we owe it to our clients, and the advisors actually will respect us more if we're just really blunt about that. The cash value life insurance, when you compare it to buy term invest, the difference, which CPAs tend to love, is that works for about 10 or 12 years, and typically there's that transitional point where the tax benefits have grown the interior of the cash value substantially enough, plus the penalties have dropped away, that suddenly the cash value looks so much better than term. And of course, term in your older years gets so outrageously expensive that it can't compete. So it does have to be long-term, it does have to be managed, and it has to stay in place, and you have to have an agent that works with the client. And I think we owe it to the clients too to turn it over to an agent who will pick it up when we retire. Because you're working with a 45-year-old couple and they're now 65 and you're retired, somebody needs to monitor that.
We already have carriers, Ken, that are set up concierge shops 24/7 direct to the consumer to help every year. Should I take withdrawals to basis? Should I do policy loans? Should I go ahead and hold my position and do policy loans through my basis because I've done really good, like on an index product?
Well, I'm really pleased to hear that. I think the industry has a responsibility to provide to the consumer those types of resources.
Well, that's the kind of thing that we're looking for. I have 2 carriers that are doing that right now. I think the industry is changing. When we come back from the break, we're going to talk about the 3 basic tax ideas in our industry, TEFRA, DEFRA, and TAMRA, and how they affect the design of income with life insurance. And don't forget, you can request all our show documents that we use as sample examples from Backroom Technician at ashbrokerage.com. And remember, you can sign up for your own 30-day free trial offer from Backroom Technician. Just go out to their website, www.brtnow.com/trialsignup.aspx. We'll be right back after the break.
Take a close look at your hard-earned dollar. How do you think your money's doing? Are you keeping an eye on it? Is it protected from taxes, inflation, and market risk? Over time, those Washingtons could become Franklins. With tax-advantaged indexed universal life from one of the largest distributors of indexed universal life, Ash Brokerage.
Hello, welcome back. I'm Steve Savant with Ken Davis. And remember, you can watch all our episodes of Let's Get Down to Business, including my weekly consumer show, Steve Savant's Money, the name of the game, at www.ashbrokerage.com. And just click on the show logo on the homepage, and it'll take you right out there. And just a heads up, before moving forward with any of the ideas you ever hear on our show, always consult your tax advisor, your legal counsel, as well as your broker-dealer compliance officer. Well, let's get down to business. We're talking about the 3 tax areas that really affected our business. TEFRA back in 81, DEFRA back in 86, and my fave, June 21, a day that'll live in economic infamy. 1988, TAMRA, the imposition. I have to say, Ken, don't you think though, I mean, honestly, as a CPA, you know our business, you've come over to the dark side now, right? Don't you think we're the most creative people, because the law keeps throwing these obstructions and we figure out ways to still make it work? I think we're the most creative industry in the financial sector.
But we have an incredibly flexible and sophisticated product, and it's continued to evolve as these laws and these rules come up. And it's a challenge, I think, for advisors really to understand fully what they're doing with this stuff. Fortunately, with software packages, with the help of an IMO that can knows the software intimately, that can design it, some other tools we have, I think we can get there. But yes, we are creative, and we have one of the most exceptional tax benefited products available.
When you think about it, we have in our arsenal, I don't want to toot our own horn, but Ash Brokerage is our sponsor of our show. We have some of the top of the line proposal illustrators in the United States that they all speak around 50 to 60 software languages and know the product inside and out. That's what I like about with our company. Ken, when we talk about TEFRA, I'm thinking about withdrawals to basis. It used to be LIFO, then it went FIFO, right? Now with life insurance, so we're still under the old rule in a way, last in, first out.
No, first in, first
Or
out.
first in, first out. But I'm thinking, we have to kind of watch the force out rule during that first 15 years. We can still do it, but we have to look at it and make sure there's no taxable event.
Well, and I would advise all agents or advisors that if they're contemplating taking distribution the first 15 years, that they call the insurance company and test it. Ask them, how much can I take out without having a force out rule where I'm going to create taxable income?
And of course, if they would say that, I would punt and do policy loans during that time.
Oh, absolutely.
Well, when we talk about that, I like that because, everything else changed, the law changed in 81. But then DEFRA came online. We used to have, this is so hard for young people to understand, especially our younger agents. There was a time when the cash values could exceed the death benefit. The accumulation, instead of doing paid up edition riders or paid up edition riders and the dividend option, you could actually go past or supersede the death benefit. Now, they changed that, the DEFRA rule. There has to be a definition of insurance, the distance between the death benefit and the cash value. There's it's like a little less than 15% spread so that it maintains its insurance integrity.
Well, as you get older, the spread gets smaller and smaller. When you're younger, the ratio of face amount to cash value is much larger. And of course, what we do as illustrators is to make sure that we keep that insurance amount down to the absolute minimum, and then also we control the distributions and whether, make sure the rules are.
Yeah, you're kissing me right into my wheelhouse here of TAMRA. This idea, and I just want to say this again, we talked about this in the first segment. If this is done correct, it is fantastic. If it's done incorrect, we try to suppress the death benefit at the cheapest death benefit option at the beginning. We also manage the death benefit during that period in time of the guideline annual and the guideline single to make sure we're always keeping the death benefit as low as we can. We're switching our options, dropping the death benefit if the computer allows us to do it, get the DEFRA quarter as low as we can so the difference between our accumulating cash value and our death benefit is the net amount at risk, and that's what we're paying cost of insurance on.
Well, and I'm going to put another plug for the IMO today, is the fact that in having played with software, some of these software packages will let you indicate, minimum life insurance. And indeed, they do a pretty good job, but they don't squeeze it all the way down, okay? And of course, life insurance companies want more insurance on the books and they want to get more premium for it. Mm-hmm. So we're really, when you're talking about a $100,000 premium, and there's 10 different people, including nephews and uncles and aunts, involved in proposing it, you really need to squeeze that down and be the person that beats the competition, even with the exact same insurance company.
Mm-hmm. I underscore how true that is, and what I'm looking at is always to mitigate every piece of the cost of insurance from the day we start at the lowest to still complying with TAMRA now, and then managing it throughout the accumulation period. And then again, if we can manage it some more at the front end of distributions, all we're trying to do is reduce the actual cost. And think about this. It is an interesting, because we're going to talk about this tomorrow. We look at the cost of that, and during distributions, our goal is to hit somewhere around 100 basis points all in. Now, it's going to be a little side, either side of that number. That's our goal on total all-in cost during the distribution period. I mean, Ken, think about that number.
Well, yeah, think about that. The fact is that people point the finger at the insurance industry as having outrageous expenses. I mean, look at some of the securities and the internal costs associated with that. And when you really dig deep and find out all the expenses and compare them, yes, in the early years, life insurance is dismal. I mean, you cash it out after 5 years, you're an idiot for having bought it. Okay?
Right. We don't ever recommend
We
that.
just are. Of course we don't. But you start getting 10, 12 years into it and you start to transition, and then we pull ahead, and then you get down to that 100 basis points. The numbers are really excellent, and that includes life insurance on top of the cash value buildup.
That's why we're in this game, because I think it's so tax advantaged. Well, that's our show for today. I want to remind you that you can read all my online insurance commentary, advisor blogs, and articles on Producers Web, and all my answers to consumer questions on Insurance Library. And remember, you can view all our shows on our on-demand section located at Ash Brokerage. So don't forget to follow me on Twitter, Facebook, LinkedIn, or email me at steve.savant@ashbrokerage.com. And remember, you could be wiser as an Ash Brokerage advisor.